Good morning. My name is Vince Lancy. This is the Gold Fix Market Rundown. We have one topic to discuss today, and that's front and center. Gold futures spiked to 35.34 last night. Tariff shock triggers historic gold market dislocation. We're going to go through the facts here. Let's start with the markets first. 10-year yields are 426, up 1 basis point. The dollar is 98.25, up 20 basis points. The S&P 500 is 63.62 and change, up 14. The VIX is 16.26, down 32. COMEX December gold futures are 34.74, up $20.50 with a 5-minute lag. Gold spot is 33.87, down $8.57 in real time. So silver, similarly, but not as aggressively. Silver futures are 38.53, up 23.5 cents. Spot silver is 38.26, up almost 3 cents. Copper is 4.38, up a little less than a penny. U.S. copper futures are 438.20, 442, up over 2 cents. WTI is 64.56, up 30. Natural gas is 301, down 4. Bitcoin down 700. Ethereum, you can see that. Palladium down 32. Platinum down 10. Gold, silver slightly lower. And grains, which are partly off your screen, are all slightly lower. If you're not familiar with the news yesterday will explain why we're putting futures up here now. The differential between gold futures and gold spot, which is almost always a function of cost of carry, which is spot plus the differential over time and money, has widened last night because of a news item. The same thing has happened to silver to a lesser extent because of fears it could happen, and copper has reasserted itself mildly. Essentially, precious metals are bifurcating in the West, hopefully temporarily, between Europe and the US, or London specifically. Here's the story. To start off, as reported here last night, we have more detail in this post here. Certainly, we can discuss this more, but for now, here is the whole story as reported by the FT and Bloomberg and curated by this publication. We will be putting out more on this topic later today. And Zero Hedge, also a very important part of the reporting on that. U.S. Customs and Border Protection has ruled that 1 kilogram and 100-ounce gold bars are subject to import tariffs, triggering sharp price dislocations between New York futures and international spot markets. The U.S. government has moved to impose tariffs on deliverable gold bars, reversing previous expectations that bullion imports would remain exempt under President Trump's reciprocal tariff structure. A July 31st CBP, that's the tariff organization, letter reclassified the bars as, quote, semi-manufactured, making them subject to duties under code 7108.13.5500. This decision sparked a surge in New York gold futures, where December contracts traded over $125 above London spot before easing back into what you see there. Switzerland, the largest exporter of kilo bars to the U.S., faces heightened trade pressures following a 39% country-specific tariff. Refiners in Asia have also paused shipments as uncertainty spreads. Industry experts warned the move could destabilize the gold futures market's pricing function, with UBS and BNP Paribas strategists questioning whether the ruling was an error or a fundamental policy change. To put a little bit of color on the mechanics of what is going on and why this is affecting the market the way it has, before giving you a very simple big picture overview. London deals mainly in 400-ounce bars. U.S. contracts are for 1 kilogram or 100-ounce bars. During COVID, the problem that's happening right now also arose. When there is demand for US delivery, London bars are sent to Switzerland to be re-refined or refabricated into US formats. London has been the default physical hub for gold for decades, while the US has focused on making a more robust futures market. Dealers in London are typically long metal in their vaults in London and hedge by being short US futures through the EFP carry trade. They are long London gold, 400-ounce bars, and short US gold, 100-ounce bars. If US delivery is called, which historically is rare because the COMEX is a paper market, and everybody knows that you should want to get your metal from London, they would take the metal that they have, their 400-ounce bar, send it to Switzerland where the refineries are, have the Swiss break down the 400-ounce bar into four 100-ounce bars, changing the format, satisfying US rules. The new tariffs disrupt that trade. A London trader, long gold and short US gold, long London gold and short US gold, now faces a choice. First of all, London traders have been doing this for years. They're long the physical and they sell futures against it legitimately to carry the differential. It's kind of like lending money out. Gold is money. And they get comfortable doing that. And it gets to be a crowded trade. It gets to be a lopsided trade. And so they have these large legacy positions that they're always massaging. But when news like this comes out, and you can't take your 400-ounce bar and put it into four 100-ounce bars to ship it to New York if someone ever wants the physical, you have a problem. You can find another refiner, not possible overnight. I wouldn't give you any. Squeeze the shit out of you, excuse me. You could do nothing and die a painful death, or you can buy back the US contract quickly. So they're short the US and they're long London. So they buy the US contract quickly, and then they decide whether or not to sell the London contract. So it's a regulatory contract issue. If somebody in the US were to say, I want the gold, as we have been doing, well, then you would have to get the gold. The driving behind the price higher is this covering or this unwinding of the EFP, which is really just a spread between London and New York. This exposes the weak link in the triangle of trade. London. London acts as an intermediary, but problems in metals markets over the last 5 years, gold, silver, and nickel, for example, and copper, have been venue or fungibility problems. Again, very similar to what happened during COVID. Supply chains that are too long are being shortened. Now, to zoom out on a little bit of a big picture thing here, because this is all part and parcel of what's been going on over the last 3 years. The big picture here is about supply chains, reshoring, onshoring, and friendshoring. Supply chains are about physical commodities, natural resources, and finished goods that they end up leading into. Gold, however, is unique. It is both a commodity with physicality to it, so it has supply chain. It's also money. And because it's money, it's actually another way to say money is I frequently call it a payment chain. Supply chain is the gold moving through the system from the ground to the vault. The payment chain is when gold is used to pay for other things. So every time you do a transaction, you use gold to pay for it. Not every time, but it's monetary. And because of that, because it's called a commodity, but they wink at you and they treat it as money, gold flows internationally across borders untariffed because you can't tariff money. So gold is unique. It is both a commodity and money. That gives it a physical supply chain, which I just described, mining, refining, smelting, selling, and a payment chain because it moves across borders as a form of settlement. What is being tariffed here is the refining and smelting part of that supply chain. What is suffering is the monetary carry trades of the payment chain that the London bullion traders have on. If President Trump intended this move, assuming it was not an error, then he is playing chicken with the Swiss. You may remember that I will say things like, you don't tariff what you want to come to you. You tariff what you don't want to come to you. And this seems, again, it could be an error, it could be a bluff, but this seems kind of backwards. Why would you tariff gold if you want it to come to you? Because when you're negotiating with a trade partner who you feel is weak and you can outlast them, you tariff the thing that you need because they need to sell it more than you need to buy it. And what happens is they fold. So the Swiss ostensibly folded, offering to move their refineries to the US, but that's neither here nor there. If Trump wins, refining capacity could move from Switzerland to the United States. Big picture still, right? If he loses, the gold Switzerland refines will continue flowing east because the East will accept it. In that case, we will have priced ourselves out of the market by effectively embargoing those formats. COMEX futures rallied, similar to what happened with copper earlier. London spot prices were largely unaffected and are now lower. This reflects the weakest link in the triangular gold trade between London and the United States, as I just said. Moving on to the immediate potential effects. If the move is intentional, it is a game of chicken with the potential to disrupt the gold market at the financial side substantially. The negotiation is with Switzerland, but it highlights that Western gold's trade weak point is physical supply in London, while Western demand is increasingly in the US, pulling the gold over here. The supply chain must shorten. Because gold is also money, restricting its movement is weaponizing our payment chain. If unresolved quickly, this will push market participants into their own corners, taking their kickballs and going home, but more aggressively, make global trade more fragmented and bilateral, with every deal negotiated separately. If Trump meant to do this, he could still adjust course, as he recently did with copper, depending on the reaction. The Swiss have already offered, as we said, at least verbally, to consider moving refining capacity to the US. It is unclear how serious that is. If it was unintentional and the result of a classification error, or Trump just bluffing to see how they'd react, the decision could be reversed within days. For now, given the opportunity, this is effectively a coin flip. Traders might use this as a point to close positions, winning or losing, until there is clarity. The implications are significant, but the core story is here. Related posts. By the way, that full story is in Tariff Shock Triggers Historic Gold Market Location. The link is there. Related post. Last night we put it out. U.S. imposes tariffs on Swiss gold bars. Yesterday we also put out UBS raises the 2025 demand roof. Suspicious, no? Founder special, Fed death, gold industry coming to America, as we thought would happen. Swiss offer U.S. its gold industry and trade talks, and the must-watch report from yesterday. Okay. We have a little note here we just want to say. Isn't it interesting? I won't say the word suspicious, that within days of each other, the Fed weighs in on gold revaluation. The LBMA is exposed as a weak link while we're trying to repatriate our own gold supply industry. These things point to potential revaluation of gold. They point to a deepening of, they definitely point to a deepening and a realization of the importance of gold in global trade going forward. They show the LBMA problems, and we need to secure our payment and supply chains for gold if we view it as an international asset that's needed. Other metals would follow. In 5 minutes, he could reverse this and say, I didn't mean it. And you could think that he's either screwed up or bluffed. And you'd say, he's a dummy. Or, and this is equally true, Trump has a habit of, most government does, but Trump has a habit of shooting and then aiming. So perhaps he shot and aimed because he wanted to see how they can react. When you're the incumbent, you get to make those mistakes. That's why Microsoft software sucks, because they can put it out and then fix it later on. Anyway, moving on. Today's Friday. Nothing is scheduled. Saturday, Vice Chairman for Supervision, Michelle Bowman speaks. Take a look at the charts. There's the chart that we're looking at there, the 5-minute chart. Gold is now, futures are up 24, and gold is down, spot is down almost 4. So people right now have rushed in to cover their gold futures and silver a little bit. And then those that panicked first either panicked best or were stupid. You don't know. These things can go on a lot longer, and it's far from over. I'm Vince. Have a great weekend.